Industry killshot: how mobile banking apps made bank visits nearly obsolete. Picture this. It's 2009, and you need to deposit a check. You drive to your bank, circle the parking lot looking for a spot, wait in line for 20 minutes behind someone arguing about overdraft fees, and finally hand your check to a teller who types information into a computer that looks like it survived Y2K by sheer willpower. The entire process takes 45 minutes of your life that you'll never get back. Fast forward just 10 years, and that same deposit takes 30 seconds from your couch while wearing pajamas. This is the story of how a handful of mobile banking apps didn't just change how we bank. They obliterated the very concept of needing to visit a physical bank branch, turning thousands of marble-columned monuments to financial authority into glorified real estate listings. The traditional banking industry had survived the Great Depression, world wars, recessions, and even the early internet revolution relatively intact. Bank branches weren't just functional necessities. They were symbols of trust, stability, and community presence. Banks invested billions in prime real estate, hiring architects to design imposing facades that screamed permanence and security. Wells Fargo operated over 6,200 branches at its peak in 2012. Bank of America had more than 5,900 locations. Chase boasted over 5,100 branches. These weren't just buildings. They were fortresses of financial services where customers conducted the sacred rituals of deposits, withdrawals, loan applications, and safety deposit box visits. The average American visited their bank branch 4.8 times per month in 2010, treating it like a necessary pilgrimage. Banks loved this captive audience because face-to-face interactions meant opportunities to cross-sell products, from credit cards to mortgages to investment services. The branch model was so entrenched that when online banking emerged in the late 1990s, banks treated it as a convenient add-on rather than a replacement, never imagining that customers would eventually prefer digital interactions over human ones. Then came the smartphone revolution, and with it, a perfect storm of technological advancement and changing consumer behavior that would reshape banking forever. The iPhone launched in 2007, followed by Android in 2008, putting powerful computers in everyone's pockets. But it wasn't just about having a smartphone. It was about what became possible when banks finally embraced mobile technology. USAA, serving military members and their families, launched the first mobile check deposit feature in 2009, allowing customers to photograph checks with their phones instead of visiting branches or ATMs. This wasn't just convenient, it was revolutionary. For the first time in banking history, you could complete a fundamental banking transaction from literally anywhere with cell service. Chase followed with their mobile app in 2010, Bank of America launched theirs in 2011, and suddenly every major bank was scrambling to digitize their services. The adoption rate was staggering. By 2012, over 30 million Americans were using mobile banking apps regularly. But the real disruption came from an unexpected source: technology companies that looked at banking and asked why it had to be so complicated, expensive, and tied to physical locations. Enter the fintech revolutionaries who treated traditional banking like a ripe target for complete disruption. Mint launched in 2006, showing users that managing finances could be simple, intuitive, and visual rather than buried in paper statements and confusing bank websites. Square introduced card readers that turned any smartphone into a payment processor, democratizing merchant services that banks had monopolized for decades. But the real kill shot came from companies that reimagined banking from the ground up. Simple, founded in 2009, offered worry-free alternative to traditional banking with no physical branches whatsoever, just a sleek mobile app that made budgeting and spending effortless. Venmo, acquired by PayPal in 2013, turned money transfers into social media, making it easier to split dinner bills than to post on Facebook. These weren't just apps, they were completely different philosophies about what banking should be. Where traditional banks saw necessary friction and multiple touch points for relationship building, fintech companies saw annoying obstacles to eliminate. They offered features that established banks couldn't or wouldn't. Real-time spending notifications, automatic savings roundups, fee-free overdraft protection, and user interfaces designed by people who understood that banking should feel more like using Instagram than filing taxes. The numbers tell a brutal story of technological displacement that accelerated year after year. Mobile banking adoption jumped from 12% of bank customers in 2011 to 73% by 2018. Branch visits plummeted accordingly. The average customer went from nearly 5 visits per month to fewer than 2 by 2015, and many customers eliminated branch visits entirely. A 2017 study found that 67% of millennials hadn't visited a bank branch in the past 6 months, and 25% had never set foot in one. But it wasn't just younger customers abandoning branches. Baby boomers, initially resistant to digital banking, began adopting mobile apps at unprecedented rates once they realized the convenience factor. By 2019, even customers over 65 were conducting 61% of their banking transactions digitally. The financial impact on banks was immediate and devastating. Maintaining a single bank branch costs approximately $2.6 million annually when you factor in real estate, staffing, security, and operational expenses. Mobile app transactions, by contrast, cost banks roughly 10 cents each. The math was undeniable. Every customer who switched from branch banking to mobile banking improved the bank's profit margins dramatically, while simultaneously making those expensive branch locations increasingly obsolete. The pandemic of 2020 didn't create the trend toward mobile banking. It obliterated any remaining resistance to it with the force of a financial meteor impact. When governments ordered lockdowns and customers couldn't visit branches even if they wanted to, mobile banking went from convenient option to absolute necessity overnight. Banks that had been gradually transitioning customers to digital platforms suddenly had to accelerate their timelines by years, not months. Branch foot traffic, already declining, fell by 85% during lockdown periods. But here's the critical insight. When branches reopened, customers didn't come back. They had discovered what millions of others already knew, that mobile apps weren't just adequate substitutes for branch banking, they were superior in almost every measurable way. Speed, convenience, 24-hour availability, better fraud protection, cleaner interfaces, and features that physical locations couldn't match, like spending analysis, automatic categorization, and integration with other financial apps. Banks that had spent decades training customers to value face-to-face relationships discovered that most customers preferred never seeing a human being if it meant avoiding wait times, parking hassles, and limited business hours. The pandemic proved that the emperor of branch banking had no clothes. Most services that seemed to require in-person visits could be handled better, faster, and cheaper through mobile technology. The branch closure statistics read like casualty reports from a technological war that traditional banking decisively lost. Wells Fargo announced plans to close over 800 branches between 2020 and 2021, reducing their footprint by approximately 13% in just 2 years. Bank of America shuttered more than 300 locations during the same period. PNC Bank closed over 160 branches in 2020 alone. But these weren't temporary pandemic responses. They were permanent acknowledgments that the branch banking model was fundamentally broken in a mobile-first world. Between 2009 and 2021, the total number of bank branches in America fell from over 99,000 to fewer than 75,000, representing the elimination of nearly 25,000 locations. That's not consolidation. That's industry collapse. The surviving branches increasingly became specialized locations for complex transactions like mortgage origination or business banking rather than everyday consumer banking destinations. Many banks converted former branches into smaller advice centers or completely automated locations with nothing but ATMs and video conferencing equipment. The few remaining full-service branches often felt like ghost towns, staffed by bored employees helping occasional customers who seemed confused about why they were there instead of using their phones. What makes this transformation particularly fascinating is how completely mobile banking apps solved problems that customers didn't even realize they hated about traditional banking. Remote check deposit eliminated the absurd ritual of driving to a bank, to hand a piece of paper to someone who would scan it into the same digital system you could access from your couch. Real-time transaction alerts meant never again wondering if a payment had processed or worrying about fraudulent charges going unnoticed for days. Mobile person-to-person payments made splitting bills, paying babysitters, and reimbursing friends as simple as sending a text message, eliminating the awkward dance of IOUs and exact change. Automatic savings features helped customers build emergency funds without the willpower required to physically visit branches and transfer money manually. Integration with budgeting tools and spending analysis gave customers insights into their financial habits that traditional banks either couldn't provide or buried in quarterly statements that nobody read. Perhaps most importantly, mobile banking eliminated the shame and judgment that many customers associated with banking transactions. No more explaining overdrafts to disapproving tellers or feeling embarrassed about account balances in front of other customers in line. The financial services industry learned a harsh lesson about technological disruption that applies far beyond banking. When your core value proposition can be delivered better, faster, and cheaper through software, your physical infrastructure becomes a liability rather than an asset. Banks that had spent over a century building competitive moats through prime real estate locations and expensive marble lobbies discovered that their most significant advantages had transformed into their greatest weaknesses overnight. The very things that made bank branches impressive, grand architecture, security guards, vault doors, formal customer service protocols, suddenly seemed antiquated and unnecessary to customers who could accomplish the same goals with a few taps on their phones. This wasn't gradual obsolescence. It was sudden irrelevance on a massive scale. The mobile banking revolution proved that entire industries could be disrupted not by competitors offering similar services more efficiently, but by technology that made the fundamental business model obsolete. Bank branches didn't lose market share to better bank branches. They lost their reason to exist to software that eliminated the need for bank branches entirely. Today, the remnants of the branch banking era serve as expensive monuments to technological disruption and changing consumer preferences. The few surviving branches operate more like specialized service centers than the community financial hubs they once represented. Most Americans under 40 view visiting a bank branch the same way they view using a payphone, an occasionally necessary inconvenience that reminds them how much better modern alternatives have become. The mobile banking revolution wasn't just about convenience or efficiency. It was about completely reimagining what banking could be when freed from the constraints of physical locations, business hours, and face-to-face transactions. In less than a decade, smartphones transformed banking from a place you visit into a service you access, proving that sometimes the most profound industry changes happen not through evolution, but through revolution. The next time you deposit a check by taking a picture or send money to a friend with a few taps, remember that you're participating in one of the most complete industry transformations in modern business history, one that turned thousands of impressive bank buildings into glorified real estate while making financial services more accessible, affordable, and user-friendly than ever before.